Good evening, everyone. I hope you're doing good for today, Monday evening, and last lecture of mine in this series of life coaching from ICI. So I can see there's Kiran, Sudhanshu, Bhumika, Rajiv. Okay. So in this last session of ours today, last session from my end, uh, we are going to study this concept of leverages. We're going to learn this concept of leverages. So we'll first talk of where this term leverage have actually, it has actually come up. So we can say first understand where this term leverage has come up, and then we can accordingly take the discussion further. Okay, and what are the calculations, what all other things are there that we can take it up in the due course of action. Okay, 1 second. Just share this screen again. Yeah. Yeah, now it's working. So there was some sort of bit of error. Right now it's all functional. Perfect. Okay, so let's talk about this term leverages. Yeah. So first we'll understand where this term leverage has come from, in which concept, and then we'll apply the same concept in our discussion. So first up, uh, this term has actually come from a term in physics, which is said to be a lever. I hope you have heard of this term lever in physics. I'm not talking in the biological sense, I'm talking of the physics in lever. Some of the examples of lever that I can give you for the given scenario, for the given case. Uh, we had this sort of seesaw games, right? We had this seesaw games in the gardens where, we used to put our efforts over here on this side, and there used to be a load which we were trying to uplift, right? One of the example is of lever is this. Then another case of lever is, when we're talking of a bottle opener, right? So a bottle opener which we use for, just excuse me for the, bad drawing, because I'm really bad at drawing, but I hope you understand what I'm trying to draw. Okay. So one is the seesaw game. The other is the bottle opener with which we used to, open the soft drink bottles, right? Uh, Another way could be, suppose if there is a big stone lying on the road and you want to move it aside, you cannot do it with your bare hands, right? You cannot do it with your bare hands. So what you typically do is we take help of a rod, or we take help of you say a big stick like this, maybe a iron stick, give it a push, and then try to just move it aside, right? So here, this side you put your effort, right? So these were some of the types of lever: type 1, type 2, type 3. In this way, we had levers in our physics. Now these three examples, that's the case of seesaw, second case of the bottle opener, and third case is that of a stone lifter. What activities are, or what these three things are essentially doing? What role are they really playing? What role are they really playing as a lever? What role are they playing? They are actually making tough tasks easier. They're making tough tasks easier, right? So all these levers are actually making our tough tasks easier, or I can say they actually cause, with less efforts, we can attain great results. With less efforts, we can attain great results. Correct? So that was the basic idea we had for levers over here. That was a basic idea with which we had this, with which we were using these levers, or uh, these tools were essentially, uh, relevant, or they were actually good for us in a sense that we were taking lesser efforts and we were able to attain greater results. I cannot open a bottle with my bare hand. I cannot lift a stone on the road besides with bare hands. I need certain tools, and these tools are essentially making my life easier, making the tough tasks to be accomplished in an easier way. And also we can attain great results with lesser efforts, right? So two aspects of lever is you can get great results with less efforts. So you can get great results with less efforts. That's the main idea, or that's the main funda that we have with respect to the levers. Now, this term leverage is actually arrived. This term leverage is actually arrived from uh, this concept of lever, that is, with less we are able to attain great results. So with this concept itself, the entire leverage concept is built around. Now, how does this leverage work? How does this leverage concept in finance work to attain great results with lesser efforts? Let's try to understand it with the help of an example, and then we'll try to go ahead with certain formula and discuss certain practical questions. So right now, let me just open a new Excel file, because that actually makes our life a bit easier. So just look at this Excel file for us. Yeah. So I'm talking of a base case wherein I'm giving you the information about units. Let me just save it so that I can share it with you after today's class. AI leverages November 23. Okay. Yeah. So let's look at a base case. Suppose a company is operating in a pattern that it is selling 1 lakh units. Okay. So in the base case, it is selling 1 lakh units. With 1 lakh units, uh, let's say the company was able to, sell it at a per unit price of 10 rupee. So at a per unit price of 10 rupee, the company was able to sell, and the variable cost which the company was incurring on a per unit basis, that was, let's say, 4 rupee. Okay. Now, let me prepare the income statement. So the income statement begins with sales less variable cost. So you get the contribution. Okay. So sales less variable cost. So we get contribution less fixed cost. So we get EBIT. Sales less variable cost. We get a contribution. From that, we reduce the fixed cost. And these all are your operating expenses. No non-operating items are being considered over here. So we have EBIT. From EBIT, we are going to reduce the interest So we get profit before tax less tax. So you get profit after tax, right? Right now we are constraining ourselves to PAT, not bringing in the preference dividend scenario for the time being. Okay. So to begin with, I can say the sales amount will be 1 lakh multiplied by 10. So 10 lakh will be the sales. Variable cost will be 4 rupee multiplied by 1 lakh units, which is 4 lakh. So we get a contribution, or let me just do one thing. I'll make this as a negative figure. Yeah. Okay. So we have contribution as, in the base case, contribution is 6 lakh. Suppose the fixed cost is amounting to 4 lakh. Okay. Or yeah, let's say fixed cost, let me give it as 2 lakh. Fixed cost is 2 lakh. So we get EBIT of 4 lakh. Interest is suppose 1 lakh. We get a profit before tax of 3 lakh, correct? And then suppose the tax is at the rate of 30%. Suppose the tax is at the rate of 30%. So you say this is 3 lakh multiplied by 30%, and PAT is 3 lakh adjusted for the tax. So that's your profit after tax. And if I take it a bit ahead and I say that number of equity shares is suppose 10,000, then we'll get the EPS figure as this 2 lakh 10 divided by 10,000, which is 21 rupees as the EPS. So this is the base case scenario, right? Now, I want you to work with two separate cases. In one case, you will say units increase or units rise by 10%. That is one scenario. And next is units fall by 10%. We're looking at two possible scenarios. What is going to happen if the units sold is increasing by 10% and if the units sold is falling by 10%? Yeah. So tell me, what will be the units? What will be the number of units which rose by 10% and which has fallen by 10%? So you can say the units will be over here 9 lakh and over here it's going to be 1 lakh 10. And now the task for you is to fill up this entire income statement on both the sides. That is for the units rising as well as for the units falling. And for that, I would prefer to give you a timer, rather I will set for next 5 minutes. Yeah, the time starts now, guys. Come on. Fill up this income statement in which we have the income statement to be completed for units to be falling by 10% and units rising by 10%. I want you to calculate what will be the impact on my P&L if the number of units sold increases by 10% or if the number of units sold decreases by 10%. Try to complete this income statement quickly, guys. Get these two income statements. Of course, this is units rise by 10%. So I'll just make it greenish. This one I'll make it greenish. Oh, my bad. And units falling Since it's on the negative side, I'll make it bit of reddish. Okay. So complete the table, guys. The timer is already set. You have to complete this table quickly. And once this table is ready, then we'll start thinking about what is this leverage all about. So last, you got another 3 minutes. I hope you all are doing it. Approx 2 minutes left. Can you tell me what's the EPS numbers? What are the EPS numbers? Okay, exactly 2 minutes left, guys. Come on. Give me the EPS numbers for both the scenarios. Units rising by 10% and units falling by 10%. Okay, so while you're doing, that's great, guys. So when units rise, we have got the numbers. EPS, Darshan has answered, Sanjeet has answered, Himanshu has also answered. It's great. This will continue to be 4. Now, of course, the sales value will be 1,10,000 multiplied by 10, right? Your variable cost will be 4 multiplied by 1,10,000. You get contribution. Fixed cost of 2 lakh. EBIT will be 4,60,000. Fixed cost is going to remain same, guys. Fixed cost is going to remain same because if your units increase, your fixed cost is not going to change, right? Because fixed cost is fixed. As the name says, the amount of expenditure is going to be constant. Your interest is also going to be a constant figure. So PBT is 4,60,000 plus 1 lakh. Tax rate is 3,60,000 multiplied by 30%. And it is also going to be a negative figure. Your PAT will be 3,60,000 plus this. Number of equity shares is 10,000. And finally, you have the EPS as 25.2. Is it 25.2? Perfect. True. Now, for the next case, when the units are falling by 10%, of course, this is going to be 90,000. This is 10 and 4. So the sales is going to be 90,000 multiplied by 10. Your variable cost is 4 multiplied by 90,000. We get the contribution. By like 40. Fixed cost is negative 2 lakhs. So your EBIT will work out to be 5 lakh 40 plus this figure. Interest will remain constant because that's not affected by the number of units. And your PBT is 3 lakh 40 plus this 1 lakh, so 2 lakh 40. And tax is this multiplied by 30%, 72,000 tax. PAT is 2 lakh 40 plus 72. Number of equity shares 10,000, and this is 1 lakh 68 divided by 10,000. So here we have these numbers when the units are reducing by 10%. Correct? We getting this? Okay. Now we are going to understand how does this leverage work? How does this leverage work? See, as compared to base case, units in this scenario, units over here, when the units are rising by 10%, when the units are rising by 10%, we can say this is going as plus 10%, right? That will be plus 10%. This is increasing by plus 10%, right? So from base case, when you go to this is increasing by 10%. You'll observe that the sales is also increasing by 10% itself. If you look at the contribution part, that is also increasing by 10%. But now, look at this EBIT figure. Is the EBIT figure also increasing by same 10%? Is the EBIT figure also increasing by same 10% as compared to the base case? As compared to the base case, tell me, is the EBIT also increasing by 10%? Is the EBIT also increasing by 10%? No. What is the percentage change in EBIT, by the way? How to get the percentage change in EBIT? So percentage change in EBIT is new EBIT minus old EBIT divided by old EBIT, right? So what is the percentage change? Just check. What is the percentage change that we are observing? It is 15%, right? Correct? Yes or no? So EBIT is actually increasing by 15%. So one side we have this increase as this is increasing by It's annoying. Leave it. You understand it, yeah. Anyways, so EBIT is increasing by 15%. Now again, if you observe, what is the increase in the profit before tax? Increase in profit before tax is also what? New profit before tax minus old profit before tax divided by old profit before tax. That is actually 20% increase, right? So what is the impact in the PAT? Look at the profit after tax figure, that is also increasing by 10-20%. And your EPS is also increasing by 20%. So as compared to the base case, we find that, yeah, we find that when the units are rising by 10%, what is the implication over here? So what we saw is a percentage change in sales. We find that percentage change in sales was 10%. That has actually led to 10% change, or 10% change in sales has actually led to 15% change in EBIT, right? So 10% change in sales, 10% change in sales is causing 15% change in EBIT. And also that 15% change in EBIT is causing 20% change in, you can say, PBT or PAT, or even you can consider the EPS. So 10% change in sales is causing 15% change in EBIT. That is also leading to 20% change in PBT, PAT, or EPS. So here is where the effort and the result comes in. Look over here. If you're taking additional 10% effort, the result that you get in the form of EBIT, and in the form of EPS, can I say that is greater than 10%, right? When you're increasing your efforts by 10%, your EBIT is actually changing by 15%, which is, I can say, 1.5 times of your efforts. And if you look at EPS or PBT or PAT as a criteria, your 1% extra efforts is actually causing double effort, that is 2%. For every 10% sales increase, you find that EPS is increasing by 20%. So when sales increase by 10%, the impact on EBIT and PBT is not same as 10%, but rather the change is a greater percentage. The change is a greater percentage, right? So when you have this greater percentage change, this is what we mean by the leverage, right? 10% change in sales causes 15% change in EBIT, and 15% change in EBIT causes 20% change in PBT or PAT. You can also say that 10% change in sales is also causing 20% change in PBT, PAT, or EPS. That's where we say effort and result relationship. Extra 10% effort is causing 15% extra result and 20% extra result in terms of PBT, PAT, and EPS. Right? So that's where we say, or we calculate the amount of, or the number of leverage. So what do we mean by leverage? Basically, we have got two types of leverages. Not rather two. We have got in all three types of leverages. Let's look at what are those types of leverages. First type of leverage is operating leverage. First type of leverage is operating leverage, which considers, you know, percentage change in EBIT. Remember, EBIT is your operating income. So this is like percentage change in EBIT upon percentage change in sales. So what is the percentage change in EBIT for a given percentage change in sales, right? That's your operating leverage. Now, in our example, if I just want to calculate, so percentage change in EBIT is 15% upon percentage change in sales is 10%, and this works out to be 1.5 times, right? So operating leverage is 1.5 times over here. So what does that mean? If you're increasing your sales by 1%, the impact on EBIT is going to be 1.5 times of it, right? That's the effort to result ratio, right? Okay, so that's the effort to result ratio. Now, that was with respect to the operations of the company. Similarly, the second leverage that we can say is financial leverage. Financial leverage is percentage change in financial leverage is percentage change in your EPS or profit after tax or profit before tax divided by percentage change in EBIT. So the leverage connecting EBIT with PBT is what we call it as financial leverage, because after EBIT, the numbers are purely dependent on how you have financed your business, right? So this works out to be, percentage change in EPS, PAT or PBT is like 20% upon 15%. So which works out to be 20 divided by 15, which is 1.33 times, right? So financially, you are levered 1.33 times. It means for 1% increase in EBIT, there will be 1.33%, or I can say one third extra result you get. Whereas with this 1.5 times, it means you're getting 50% extra results. Finally, the ratio or the leverage that we have is last one is combined leverage. Combined leverage. So guys, combined leverage is calculated as percentage change in combined leverage is percentage change in your PAT, EPS or PBT due to a percentage change in sales. So which is essentially like 20% divided by 10%, which is 2 times, right? So combined leverage is percentage change in EPS or PAT or PBT upon percentage change in sales, which is 2 times, correct? Okay, you can also say, sir, combined leverage is essentially operating leverage into financial leverage also, like 1.5 into 1.33. That will also give you answer as 2 times, right? So operating leverage is 1.5 times, financial leverage is 1.33 times, and combined leverage in the given case is 2 times. So the percentage changes that we can say, when you're connecting percentage in sales with change in EBIT, you're actually talking of operating leverage. When you're connecting EBIT with PAT, PBT or EPS, you're talking of financial leverage. And when you're connecting the percentage change in sales with PAT, PBT or EPS, that's your combined leverage. That's going to be the combined leverage. Now, my question to you is, leverage is what? Additional efforts will lead to extraordinary, or increase, or ordinary efforts will lead to extraordinary results, right? Ordinary efforts will lead to extraordinary results, extraordinary increase in results. So my question to you, is it good or bad? Is it good or bad? Having operating leverage as 1.5, or having operating leverage, having financial leverage, is it good or is it bad? Yeah, tell me guys, is it good or bad? Tell me. We are having in the given question some amount of operating leverage and financial leverage and combined leverage. My question to you is it good or bad to have leverages in your balance, in your books? Well, to understand it, you can simply say, so it's good as well as bad, because if a 10% extra effort results in more results, like a 10% extra effort results in 20% more results. If it results in 20% more results, the opposite can be also a case, when your results fall by 10%. When you just try to reduce your uh, you know efforts by marginally, by few percentage, you will find that the impact on the PNL, or impact on my PNL, is also substantial, right? So you can just see over here that here you'll find it to be in a decreasing trend. See, look at these numbers, the numbers which we have computed for increase in units. What can we observe for the numbers when the units are falling by 10%? So when there is a fall in efforts by few percentage, by few numbers, the impact on the fall in EPS and your EVIT, that is also larger, right? So is it good or bad? So leverage, is it good or bad? You cannot say leverage is good or bad, because leverage is, what essentially it is? Leverage, if it is good as well as bad. And now tell me, what is it that is good as well as bad? What is it that's good as well as bad? Tell me, guys. What is it that's good as well as bad? So what we are saying over here is that leverage is good as well as bad. We talk of leverage, it is good as well as bad. So what is it that we call it as? What is the leverage? What is the aspect where we call it is good as well as bad? Yeah, tell me, guys. Well, leverage is actually a measure of risk in the business. Right? So leverage is a measure of risk, because risk is good as well as bad if you are able to uh, use the risk in your favor. If your business functions in your favor, then the leverage is going to be favorable for you, because it will maximize your results. Whereas if it's not in your favor, then the results are going to be a totally different thing. So risk wise, we have operating risk. How much risk is the company undertaking in its operations? Then we may have also the financial risk, which is measured by financial leverage. And we talk of total risk, which is measured by Total risk is measured by the combined leverage. So essentially, what do we mean by leverage itself? Leverage means the level of risk. Leverage means the level of risk, guys, right? So it can be operating risk, financial risk, or total risk. So leverage means the level of risk that you are undertaking. Leverage means the level of risk that you are undertaking. Operating leverage indicates what is the level of risk that you have in the operations. Financial leverage means what is the level of risk that you have in your finances or in your financial statements. Combined leverage means what is the level of risk that you have at a combined level. In a combined level, what's the risk that you are undertaking? That's what we mean by the combined leverage, guys. Okay. So these are the numbers, or this is what the concept is. But so do we need to always calculate this, what is the percentage change in sales and EBIT, and prepare this full statement, prepare this entire statement and again for calculating it? No, we have got some shortcut formulae to calculate the leverages. I'll give you the shortcut formula, uh, and then I'll derive it for you, right? So just calculate some shortcut formula for it, and then we'll derive it accordingly. See, operating leverage, the shortcut formula for that is contribution upon EBIT. That's your contribution upon EBIT. Financial leverage is EBIT upon profit before tax. Combined leverage is contribution upon profit before tax, right? Okay, Darshan is asking how an increase in leverage indicates an increase in risk. See, Darshan, if your leverage is high, it means a small change in your units is going to have a very drastic impact, right? There'll be a drastic impact on your EPS. So high leverage means there will be a greater impact on your EPS. So that's where it indicates as a risk, right? The risk is like what will be the impact on your EPS? What will be the impact on your shareholders' earnings? So if there is going to be a very drastic impact on shareholders' earnings, then that's where we say that it is a risky scenario, correct? Now, coming over here, operating leverage, combined leverage, and the financial leverage, I will try to introduce, try to derive this for you. So I'll just derive one formula, which is operating leverage, and then later on we can, you can connect it with the other aspects also. So operating leverage, the formula was percentage change in EBIT upon percentage change in sales, right? And what you can observe is, so percentage change in EBIT was 15% over here, but percentage change in contribution is same as percentage change in sales, correct? You can find it over here, see, 10%, 10%. So whatever is the percentage change, whatever is the percentage change in EBIT, that is same as percentage change in contribution, right? And this divided by percentage change in, sorry, my bad. Numerator is going to be percentage change in EBIT upon percentage change in contribution, right? Now, how do we calculate this percentage change in EBIT? Percentage change in EBIT is EBIT new minus EBIT 0 divided by EBIT 0, the whole divided by contribution new minus contribution old upon contribution old. So I can rewrite this as, let me just name it as EBIT 1 minus EBIT 0 divided by contribution new minus contribution old, the whole multiplied by contribution old upon EBIT, EBIT old. Just rearranging the terms, right? So rearranging the terms. Okay. So now if you look at the numbers, EBIT, the difference in EBIT and difference in contribution, what can you say about that? See, what can you say about, see, the contribution numbers and the EBIT numbers? Look at the contribution numbers and EBIT numbers. The difference between them. What's the difference between the contribution numbers and difference between the EBIT numbers? Can I say that is same? Which is 60,000, correct? See, contribution earlier it was 6 lakh, now it becomes 6 lakh 60. So amount wise, it is 60,000 for contribution as well as EBIT. So amount wise, since they are same, I can cut these two numbers, right? Because both of them were actually 60,000. Because the difference between the old and new EBIT and contribution is 60,000. So finally, what you can say as operating leverage is contribution upon EBIT. Correct? That is the original contribution upon EBIT. So that's how we can derive at this formula of operating leverage as contribution upon EBIT. Same way you can carry out the derivation for combined leverage and financial leverage also. Okay, so for us to remember, we need to remember these three formulae, that is operating leverage, combined leverage, and financial leverage. So we need to remember these three leverages. Okay, let me just see at the doubts. Any queries? We can change our EBIT and EPS by changing. So how can increase the leverage indicator? Okay. In why PAT is not taken, PBT is taken. That's a derived formula. Darshan, just like in operating leverage, we converted the percentage change in sales to percentage change in contribution so that I get the amount of change in contribution and EBIT is same and we can cut it, right? Sir, but EPS is always increasing by rise in units. Why are you calling leverage as a risk? By rise in units, your EPS will increase, correct? But what if there is a fall in units? If there is a fall in units, your EPS is going to fall at a much faster pace than otherwise, right? So EPS is going to fall at a much faster pace than otherwise. So that's where you say this as the operating leverage. That's where you say that this is to be risk, right? Got it? Shubham is asking contribution mean expenses. Shubham, contribution is not expenses. Contribution is sales as reduced by the variable cost. Sales as reduced by the variable cost. Okay. Are we getting it? So what we need to remember is basically the basic fundamental formula for operating combined and financial leverage. Leverage should neither be very high and very nor very low. That's not a proper comment for leverage, Darshan, because when you say that leverage is very high or very low, it depends how your sales is going to function in future. So if you anticipate that sales are going to be, sales are going to be growing at a much faster pace or at a greater strength, then you can say that it is uh, in your favor. But when you anticipate that sales are not going to be very strong or your sales is going to fall, you should start reducing your leverage by pulling back your fixed cost. Because if I ask you what is the main reason for leverage, why do we have leverage in our financials? What is the reason? It's the fixed cost. It's the amount of fixed cost that is bringing in the amount of leverage, right? So you need to reduce your fixed cost if you're anticipating a reduction in a sales, correct? So that's where you see that this, layoffs are happening in technology companies. In the tech companies, take for the case Infosys or any Cognizant, Microsoft, Facebook, all these companies are, laying off or they're firing their employees, they're removing their employees. Why? Because they're anticipating a reduction in the sales. So as they anticipate a reduction in the sales, they first try to reduce the fixed cost whichever is possible. And the only easier way to reduce the fixed cost is to fire your employees. Yeah, got it. So therefore, we say, uh, leverage cannot be said to be good or bad. It's both good as well as bad. Now it depends whether you want to take the advantage of it during the rising times and try to reduce the leverage by reducing the fixed cost by uh, when the times are not so good, right? So if leverage, Bhumika is asking leverage increase, then this will be less risky, and leverage decrease, this will be high risky. Leverage, if it is higher leverage, it means it's a risky scenario. If it is lower leverage, then it's a less risky scenario. Interest is also a fixed cost, Shubham, because your interest is not dependent on the volume of sales. Interest expense is not dependent on the number of units that you are selling, right? Got it? Yeah. Okay. Now, with this basic formula in hand, uh, I would like to give few questions for solving before in the first half of our session, and then we'll take up the questions from the module. Let me just put up some questions over here. Yeah, here we have this questions. Uh, I would like you to solve this question typically, guys, particularly this one. Yeah, this question. Let's try to solve it. Rather, I'll do it in part. I'll do a part of it. There are three companies given to us, A, B, C. We have the financial leverage. We have to prepare the income statement. So I'll prepare income statement of A, and for B and C, I would require you to prepare the income statement. So let me just have the draft of income statement A, B, and C. So we say sales less variable cost. So we get the contribution. From that, we reduce the fixed cost. So we get EBIT. From that, we further reduce the interest. So we get profit before tax. Then we reduce the taxes so that we get profit after tax, right? So sales less variable cost, contribution less fixed cost, EBIT, interest, PBT until PAT. So based on this, what information we have is the financial leverage is given to us, operating leverage is given to us, Uh, Interest expense is given as 200 rupee. So let me write down the interest expense as 200. Financial leverage 3 is to 1. Operating leverage 4 is to 1. Variable cost as a percentage of sales is 66 2 by 3 and income tax rate is 45%. So interest is 200, operating leverage 4 is to 1 and variable cost is also given. Now we have to start our calculation taking this. Tell me which leverage is connected with interest. Which leverage is connected with interest? Is it the financial leverage? Is it the operating leverage? Or is it the combined leverage? Which leverage is connected with interest? Of course, it is the financial leverage. So let's take help of financial leverage. For A Limited, doing the calculations fully for A Limited. For A Limited, we have financial leverage. We have financial leverage as 3. And we know that financial leverage, the formula for financial leverage is the shortcut formula for financial leverage was earnings before interest and tax upon profit before tax. Financial leverage, EBIT upon PBT, right? So we say this as 3 equal to EBIT upon PBT. We don't know what is earnings before interest and tax, but we know that PBT is going to be earnings before interest and tax minus interest. Correct? So if you just do the further thing, so this is 3 equal to EBIT upon EBIT minus interest for A is 200. So EBIT minus 200. So we get 3 EBIT minus 600 is equal to EBIT. And therefore we say 2 times of EBIT is equal to 600. EBIT is, basically 600 divided by 2, which will be 300. So EBIT, we get it as 300, right? And once we get the EBIT, we can also get the profit before tax as 100. Tax will be anyways 45 rupees because tax rate is given as 45% and that will be 55. Now, once we have got this PAT figure, now if we just do the backward calculation for other numbers, what we have is operating leverage is given as 4 is to 1. And operating leverage, if you can recall the formula for operating leverage was contribution upon EBIT. Formula for operating leverage was contribution upon EBIT. So we have to use that formula for it. Operating leverage is given in the question to be 4 is to 1. And we know it is calculated as contribution upon EBIT, which is 4. Right. So contribution upon EBIT. Do we have the number of EBIT? Yes, we have the number of EBIT of 300, right? Yeah. So we get this as 4 equal to contribution upon EBIT of 300, correct? So therefore, we get the contribution number as 1200. Correct? So contribution number is 1200. That's fine. We got contribution as 1200. So we get the fixed cost as a balancing between them. That is 1200 and 300. We can say the fixed cost is standing as 900. Correct? We got, we have used this financial leverage, interest, operating leverage, income tax rate. Now what we have is variable cost as a percentage of sales. Variable cost as a percentage of sales. Okay, so we have variable cost as a percentage of sales. Variable cost as a percentage of sales is 66.2 by 3%. Darshan, you cannot use the formula for operating leverage. Has to be contribution upon EBIT. It cannot be sales upon EBIT because we have derived it. It's only the contribution and which gets cancelled that's left out. Okay, otherwise sales upon EBIT is not a correct formula. Variable cost as a percentage of sales is given as 66.2 by 3. Now, what we have in the income statement is contribution is 1200, right? So this 66.2 by 3 is obtained as variable cost upon sales into 100, right? So 66.2 by 3 is now how do we get the uh, variable cost or the other figures? Essentially, uh, this sales, I can variable cost, I can actually say it as sales will be, can consider that as a figure because we have this contribution available for us, right? And sales minus variable cost is contribution. So since we have this information as sales minus variable cost is contribution, right? So I can say variable cost is contribution or variable cost is sales minus contribution, right? So I can call this as sales minus contribution upon sales into 100 is this. 66.2 by 3 is, what's the value of the sales? Well, guys, we don't know what's the value of sales, so let me take it as X. X minus contribution. By the way, contribution we have computed as 1200. Contribution is 1200 upon X into 100. So you can say this is 66.2 by 3. So if I convert it into proper fraction, that will be like 66 into 3, 198 plus 2. So that's 200 by 3. 200 by 3 into 1 by 100 is X minus 1200 upon X. So this is just 2 by 3 is X minus 1200 upon X. So if you just cross multiply it, 2X is equal to 3X minus 3600. So 3600 is equal to X. So what was X, by the way? We have taken the sales as X, right? So we get the sales figure as 3600. Sales is 3600. So we place that sales 3600 over here, right? And you can say the variable cost is basically the balancing figure between both, which is 2400. Okay. Is this clear? I hope you're clear. How do we get this income statement ready? Are we clear with it? Yeah, guys. Are we clear with this? So can you solve on a similar lines for B and C? Yeah. Tell me, guys, can you solve it for B and C? I have done it for A on the similar lines. Can you do it for B and C? Can you solve it for B and C? Yeah. Okay. So then in that case, uh, let me just put a timer, correct? So the timer would be, we'll have a 5 minutes timer, right? I'll have a 5 minutes timer. And then later on, once the timer ends, we'll take a break of next 10 minutes. After that, we'll discuss the solution. Okay, so the timer of 5 minutes has begun. So after the next 5 minutes, we'll take a break. And then after that, you will solve it while the break is ongoing. So I give you like 10-15 minutes break. And in that break, you're supposed to be solving both the B and C. And then we'll discuss it once we are back. So right now, the timer is ongoing. Yeah, someone is asking, Mr. Sanjeet. Can we assume sales as 100 and subtract the variable cost percentage to the contribution? Yes, Sanjit, you can. You can do that definitely. You can do that. I have put up the format also for your screen. You can just take down the numbers and try to uh, get the entire income statement. Okay, question is not visible. Okay, you can take down the question if that's not visible for you. Here we go. First, take down the question. I hope now it is visible. Yeah. Just take down the figures and then start working. For 2.5 minutes before we go for the break. I hope you have started solving. And when I come back from the break, or when we come back from the break, I want to see the answers. Have you all started with the solution? Can you see the figures, guys? Yeah. I think guys have started solving it. Okay. So are we done with at least one? The company B, is it done? B, you can begin it on the similar lines. You can just take uh, the interest figure as 300, and then you just need to work around the leverage figures. This is 300, and you have the financial leverage as 4:1. When you have financial leverage as 4:1, uh, number, I think you should be getting EBIT as should be 400 EBIT, and you have PBT as 100, right? Then you have the 45, this is also 55. Then you have the operating leverage as 5:1. So this should be like 2000. So essentially the fixed cost should be 1600. Variable cost as a percentage of sales is 75%. So this should be like 6,000, and your sales figure should be 8,000. So you should be done with this part B. Now you can just solve this part C in the break and then come back for the final answer. So right now let's take a break of 10 minutes, guys. See you in the next 10 minutes. Welcome back after the break, guys. I hope you would have completed the part C of the question. Part C, it should be 12,000 sales with a variable cost of 6,000, contribution being 6,000, fixed cost is 4,000. We get a EBIT of 2,000, interest of 1,000, which will give you a PBT of 1,000, tax is 450, and PAT is 550. Perfect. So we're done with the question over here. Now, let me look at um, some more questions. I'll just go in the backward scenario. Let's look at this question. Yeah. Sale revenue of TM Excellence Limited at rupees 20 per unit of output is rupees 20 lakhs. Contribution is 10 lakhs. At a present level of output, degree of operating leverage is 2.5, and the company does not have any preference shares. The number of equity shares are 1 lakh. Applicable corporate income tax rate is 50%, and the rate of interest on debt capital is 16%. What is the EPS at sales revenue of 20 lakhs and the amount of debt capital of the company if a 25% decline in sales wipe out the EPS? Okay, so let me just put up the income statement from whatever numbers we can look for. Sales less variable cost, so you get contribution. From that, we subtract the fixed cost to get EBIT. From EBIT, we subtract the interest, so we get profit before tax. From that, we reduce the taxes. Do we have the tax rate given? Yeah. Corporate tax rate is 50%. Yeah. So we get the profit after tax. Now, coming to the numbers, we have the sale revenue of TM Excellence is 20 lakhs. Sale revenue is 20 lakhs. Contribution is 10 lakhs. Variable cost is obviously the balancing figure 10 lakh. At the present level of output, degree of operating leverage is given as 2.5. Degree of operating leverage is 2.5. The company does not have any preference shares. Okay. And number of equity shares is 1 lakh. Applicable income tax rate of interest is given. Now, degree of operating leverage is 2.5. We know this is going to be contribution upon EBIT, right? 2.5 upon contribution is 10 lakh upon this 10 lakh divided by 2.5. So EBIT will be 10 lakh divided by 2.5, which is 4 lakh. Okay, so we get a EBIT of 4 lakh. This simply gives us the balance over here as a fixed cost, and the fixed cost is simply 6 lakhs. So from 10 lakh, we subtract 6 lakh, we get the EBIT of 4 lakhs. Now, for interest component, that being that interest on debt capital is 16%, corporate tax rate is 50%. What is the EPS at the current level? What is that is what they're asking. So I think, from PAT, I need to divide this by number of equity shares to get EPS. So what is the EPS at a sales? Revenue of 20 lakh, amount of debt capital of company. What should be the debt capital? When it says that 25% decline in sales will wipe out EPS. Okay. So now they're saying that if there is a 25% decline in sales, that will wipe out EPS. Now, which is the leverage that connects sales with EPS? Of course, it's the combined leverage. Now, for combined leverage also, we don't have, we have operating leverage, but we don't have the financial leverage. So the only way by which we can talk of is when the sales is going to decline by 25%, the EPS is going to become zero, right? So we have the new, the sales figure, or I can say when there is a 25% decline in sales. So let us consider 25% decline in sales. So what will be the sales figure? If there's a 25% decline in sales, what is the sales figure? Sales figure is 15 lakhs, right? And it says that at a sales figure of 15 lakh, your EPS will be zero. So let's try to work around, because now the contribution is 10 lakh, which is essentially, if you're making a sale of 20, you have a contribution of 10. That simply means that over here contribution is going to be 7 lakh 50,000, which is half of the sales, following the pattern over here. See, from 20 to 10 lakh, we can say this is less 50%. Right, 7 lakh 50,000. From 15 lakh, you subtract 7 lakh 50, so you get a contribution of 7 lakh 50. And we don't know about fixed cost and all such numbers. But over here, we can say fixed cost is what we have computed already as 6 lakh. So fixed cost is 6 lakh. So we get a EBIT of 1 lakh 50,000. Now, I don't have any information over here, but it says that EPS is zero. So whatever be the number of equity shares, what's the count of number of equity shares? Number of equity shares is 1 lakh. So for 1 lakh equity shares, you say that EPS is zero. So PAT is also supposed to be zero, right? So if you want your EPS to be zero, the PAT also has to be zero. Then doing the backward calculation, sir, if your PAT is zero, it means you shouldn't be paying any tax, and rather your PBT will be also zero, because if you want your PAT to be zero, your PBT has to be zero. Correct? Now, from PBT, you subtract the tax, you get a PAT. Interest of 1 lakh 50,000, and your PBT is zero. That simply states what is the figure of interest. So interest is 1 lakh 50,000, and this same interest is going to be at this level because interest is a fixed cost. We have the interest as 1 lakh 50,000. Divided by subtracting that, you get 2 lakh 50,000. And on this 2 lakh 50,000, you can say that you're paying a tax of 50%. So 2 lakh 50,000, tax of 1 lakh 25,000. So you have 1 lakh 25,000 divided by 1 lakh, which is 1.25. So EPS, earnings per share, is 1.25. Okay. So sales, from that you subtract the variable cost, you get a contribution, and then you reach up to a EPS level of 1.25. That's your income statement. But now the question is asking us what is the value of EPS and also the amount of debt capital. See, The amount of debt capital. Amount of debt capital will be interest of 1,50,000 divided by rate of interest is interest on debt capital is 16%. So if you just divide it, 1,50,000 divided by 16% is 9,37,500. Okay. Shubham is asking, sir, why PBT is zero? PBT has to be zero, then only your PAT is going to be zero, right? Because your tax is 50% of PBT. So of course, if your PAT is zero, it means or you won't be paying any tax also. Right? So no profit, therefore you're not paying any taxes, and therefore you have a PAT of zero also. Are we good with this question, guys? Did we get it? Easy? Easy for us? True? Yeah. Okay. Then let's take up some more question. Let's try to solve this question now. How did you get the number of equity shares? Sudhanshu, number of equity shares is already given in the question. Number of equity shares are 1 lakh. Darshan, decline in sales will wipe out EPS. It denotes combined leverage, but regards to combined leverage, there is no information given in the question. So we can't work around that combined leverage. We have to solve it by looking at what will be the case if 25% decline in sales is happening. Okay, so now let's look at this question number 8 that we have. Rate of interest is given as 16%. Why to compute all this? Rate of interest is given 16%, but the question asks you what is the amount of debt capital. Now for debt capital, you don't know debt capital, they have just given you 16%. So how will you get the rate of, how will you get the interest? That has to be done only with taking into consideration the 25% decline case. Okay. So here we have this question. The following data have been extracted from the books of LM Limited. Sales is 100 lakhs. Interest payable per annum is 10 lakhs. Operating leverage 1.2, combined leverage 2.16. You're required to compute the financial leverage, fixed cost, and the PV ratio. By the way, PV ratio, guys, it means contribution upon sales, right? So can you solve it? I can set a timer for this. Can you give it a try, guys? Question 8 in rough. Try to solve it in next 5 minutes. Try to solve it within next 5 minutes. Question is not visible. 1 second. I think now it should be. Yeah. Yeah. Try to solve it. Get these 3 numbers from question 8. Timer is set, guys. Try to solve it within the pre-decided time. Okay, we have approximately 1.5 minutes left. No variable costs. Operating leverage information is given, Darshan. So I think with that, we'll be able to solve it. Okay, so time is up, guys. Let me quickly answer it. The question is given as the combined leverage and the operating leverage. The financial leverage can be very easily computed because we know combined leverage is the operating leverage multiplied by financial leverage, and combined leverage is 2.16. Operating leverage is 1.2 into financial leverage. So financial leverage will be 2.16 divided by 1.2, which is 1.8, right? So we get this financial leverage as 1.8. Now we have the interest payable. So we going to need to compute the fixed cost, PV ratio, and all such items. So first, let's try to draft the income statement. We have the sales figure available. So sales less variable cost. We'll get contribution From that, we reduce the fixed cost. So we get EBIT. From that, we reduce the interest. So we get profit before tax. And then you subtract tax so that we get profit after tax. So sales figure is given as 100 and interest payable is 10 lakhs. Sales is 100, interest is 10 lakhs. Now 100, 10 and operating leverage is 1.2, combined leverage is 2.16. So beginning with the interest, we have got this financial leverage count, right? So we'll use that formula since financial leverage is 1.8, which is EBIT upon PBT. 1.8 is EBIT upon PBT will be EBIT minus interest. So 1.8 is equal to EBIT upon EBIT minus 10, right? So you get this as 1.8 EBIT minus 18 is equal to EBIT, which means 0.8 EBIT is equal to 18. And therefore EBIT will be 18 divided by 0.8. EBIT is 22.5. So EBIT is 22.5. We get a PBT of 12.5. And then the tax is anyways not much of relevance. But now we have to use the combined leverage, or we can also use the operating leverage. Here is the operating leverage. Operating leverage number is 1.2. So operating leverage is contribution upon EBIT is 1.2. So we say contribution is to be found out. Contribution upon EBIT figure is 22.5. So therefore contribution will be 1.2 into 22.5, which is 27. So contribution is 27. That paves way for this thing. So this should be like 4.5. That's 27 minus 4.5. And the variable cost will be the balancing 73. From this, we can get the PV ratio also as what? 27 upon 100, which is 27%. 27 upon 100, which is 27%. Also, we have got the fixed cost. I think many of you have got the correct answer. Fine, yes. Perfect. Now, I want to look at this question number 4 as of now. Let me take this question number 4 into consideration. Yeah, so operating income of a textile firm amounts to 1,86,000. It pays 50% tax on its income. Its capital structure consists of the following. Okay. Darshani, that's what is the full form of PV. PV is the price volume ratio. What is margin of safety? Margin of safety is basically, break-even point, right? So any sales above break-even point is margin of safety. So if you are selling, let's say 100, and your break-even point is, let's say let's say 30. So your margin of safety is 70. So sales above break-even point is your margin of safety. Okay, I think I have answered you, Darshan. Now let's come to this question 4. The operating income of textile firm amounts to 1,86,000. It pays 50% tax on its income. Its capital structure consists of the following: 14% debentures 5 lakh, 15% preference shares 1 lakh, equity shares of 4 lakh. So that's your capital structure. Determine the firm's EPS. What percentage change in EPS associated with 30% change in EBIT? So if your EBIT is going to change by 30%, what will be the change in EPS? What is the degree of financial leverage? And what additional data do you need to compute the operating leverage? Anyways, we have this operating income. We have this term called as operating income. Can you tell me what is this operating income, sir? This operating income is essentially EBIT, right? So this is EBIT. So from question, we can say that our earnings before interest and tax is 1,86,000. EBIT is 1,86,000. It pays 50% tax on its income. So operating income EBIT of a textile firm is 1,86,000. It pays 40%, it pays 50% tax on its income. Its capital structure consists of, so you have 14% debentures. From this, we'll subtract the interest, which is simply 5 lakh into 14%. So 5 lakh into 14%, that is 70,000. So you get profit before tax as 1,16,000. So EBIT is 1,86,000 less interest of 70. PBT is 1,16,000. From that, we'll have to subtract the tax figure, where the tax rate is 50%. So 50% of 1,16,000. 58,000, which is again 58,000. Then this is a PAT, but our income statement doesn't stop over here. Income statement doesn't stop over here because from this, we're going to subtract the preference dividend, and then finally we get net profit for equity shareholders. So now preference dividend is 15% of 1 lakh. That's 15,000. And net profit for equity shareholders is 43,000. Net profit for equity shareholders is 43,000. Determine the firm's EPS. So of course, this needs to be divided by the number of equity shares. What's the number of equity shares? We have 100 each. So equity shares count is 4,000. So EPS will be 10.75. Okay. So first part is done. Now the second part. Determine the percentage change in EPS associated with 30% change, both increase and decrease in EBIT. Okay. So we were looking for EBIT increasing by 30% and also EBIT decreasing by 30%. So if EBIT increases by 30%, that's 1,86,000 into 1.3. So that should be like 2,41,800. And if your EBIT 1,86,000, it decreases by 30%, that is 1,30,200. Interest will be 14% of debentures. So I want you guys to complete this portion. complete this portion fully. And then you have to calculate the degree of financial leverage over here. So remember, financial leverage, you're going to compute it by the original method, not by the shortcut. Because if you look at the shortcut, you will get a incorrect answer. So you need to calculate percentage change in EPS due to percentage change in EBIT. Because remember, over here, preference dividend is coming up as a new type of fixed cost. So we need to look into that account also. So now the task for you is to uh, complete this income statement and then calculate the financial leverage. Then I'll definitely come up with the shortcut formula. I'll come up with a shortcut formula for the scenarios where you have the preference dividend, because financial leverage, preference dividend, financial leverage that we have seen, the shortcut formula, that's not applicable for the cases where you have the where you have the preference dividend. So to make the preference dividend applicable, there's another shortcut formula which I will derive it. But as of now, just try to complete this income statement, guys. I am again setting the timer to next 5 minutes. Setting the timer to next 5 minutes. Try to solve it. Yeah. Come on, guys. Get the EPS at both the levels. Get the EPS at both the levels quick. Okay. I think this time you are answering before time. Okay, 2 minutes left. Okay. Financial leverage numbers have also been derived. Okay, let me just begin with it. This is going to be 70,000. Interest is going to be a constant figure. And 1 second, let me just finish up this one first. So you have 2,41,800 minus 70,000. That's 1,71,800. Tax rate is 50%. So 171,800, which is 85,900. And then you get 85,900 as PAT. Preference dividend is 15,000. You get the net profit for equity shareholders as 900 minus 15,000, which is 70,900. And then this divided by 4,000 will bring our EPS as 17.725. Is it the answer that you're getting? Yeah, perfect. 17.725. Then for the other case, interest 70,000 subtracted 130,200 minus 70,000, 60,200. Then we have the tax as 30,100. Also 30,100. Preference dividend is 15,000. This is 15,100 divided by 4,000. Which is 3.775. Perfect. So now percentage change in EPS over here, this percentage, how much is the percentage change? 17.725 minus 10.75 divided by 10.75, right? So this percentage change is 17.725 minus 10.75 divided by 10.8, 17.725 minus 10.75 divided by 10.75, which is 64.88%. 64.88% is a percentage change in EPS, right? Plus that's 17.725. 1 second. Minus 10.75 divided by, originally it is 10.75, which is 64.88% divided by percentage change in EBIT will be 30%. So this divided by 0.3. So your financial leverage number should be 2.16, guys. Financial leverage number should be 2.16. Now, if you apply the shortcut over here, you will find that it will not match with it. So if you just go about applying the shortcut of financial leverage as EBIT upon PBT, what you will get is EBIT is 1,86,000. So EBIT is 1,86,000, and if you divide it by PBT of 1,16,000, that's actually not going to work because 186 divided by 116. That comes out to be 1.6, which is obviously a wrong answer. So this formula is also wrong over here. Rather, financial leverage formula is going to be EBIT upon profit before tax minus preference dividend upon 1 minus T. So what we are doing is From this profit before tax, we are subtracting the grossed up value of preference dividends. If I apply this formula, you can see that it will match 1,86,000 upon 1,16,000 minus preference dividend, which is 1,000 upon 1 minus tax rate. Tax rate is 50%. So if you apply this 1,86,000 divided by 1,16,000 minus 30,000, so that's 1,86,000 divided by 1,16,000 minus 30,000, which is 86,000. Now, if you divide it, 186 divided by 86, you will find that here it tallies. So remember, when you have preference dividend as one of the component for the capital structure, you have preference dividend as one of the component, then you cannot divide it directly. You'll have to use this long cut formula. You'll have to use this formula for financial leverage. Does it make sense to you guys now? Is this funda clear? Are we good fundamentally? Yeah. Are we good? Yeah, fine. Now let's do just probably one more question. Then the third. Okay, let's try to do this question now. The following details of RST Limited for the year ended 31st March 2006 are given below. Operating leverage is 1.4, combined leverage is 2.8. Fixed cost excluding interest is 2.04 lakhs. Sales figure is 30 lakhs. 12% debentures amounting to 21.25 lakhs. Equity share capital of rupees 10 each, 17 lakhs. Income tax rate is 30%. Yeah. So calculate the financial leverage. We have to get the PV ratio and the EPS. So first, try to get these two numbers. Then we will look at the third and fourth part. And then for that, for this question again, I'm giving you a similar 5 minutes timeline. For the next 5 minutes, try to get the first two answers quick. Don't worry, Darshan. I'll upload this entire PDF file on the portal. Yep. Get the financial leverage and calculate the PV ratio and the EPS. I will upload it, Darshan, don't worry. Try to get the financial leverage and PV ratios, guys. To take help of combined and the operating leverage. Fixed cost is to be used for operating leverage and further calculations. So 2 minutes left. Come on, guys. Okay, so we're almost beat done. I think the time is up. Now let's look at the solution, guys. We have the already solution is available for this. So let's just try to discuss it quickly. Yeah. So the question says it's given as operating leverage is 1.4 and 2.8. We have this operating leverage and financial leverage available for us, 1.4, 2.8. Now, financial leverage can be easily computed as 2 because combined leverage is operating leverage into financial leverage. The operating leverage, we know it is 1.4, which is to be computed as contribution upon EBIT. So operating leverage is contribution upon EBIT. And we know it is contribution upon EBIT. So EBIT can be contribution minus fixed cost. So contribution minus fixed cost, contribution minus fixed cost of 2,04,000, right? And by simply solving this, you can get a contribution as 7,14,000. So while we are drafting the income statement, we'll say contribution is 7,14,000. Given fixed cost is 2,04,000. So you can do the simple backward calculation over here also. That since the sales is 30 lakhs, so sales 30 lakh and contribution is 7,14,000, balancing will be variable cost. Okay, then so you get the EBIT by subtracting that. Interest is 2,55,000, which is 12% of 21.25 lakhs, right? So get this, and then profit before tax is 2,55,000. Tax is 76,500. So PAT is PBT minus tax, which is 1,78,500, divided by number of shares, which is 1,70,000, EPS of 1.05. Okay. Now the question says PV ratio. PV ratio will be simply 7,14,000 divided by 30, which is 23.8. Right. So we get the PV ratio and the EPS also. Now it says as compared to the industry whose asset turnover is 1.5, does it have a high or low assets leverage? So if our company belongs to an industry whose asset turnover is 1.5, does it have a high or low assets leverage? So the company is belonging to an industry where the turnover is 1.5, asset turnover is 1.5. And over here, whether we are having a high asset turnover, low asset turnover, that's what the question is asking. So asset turnover is sales upon assets. So going by that 30 lakh divided by, because asset means obviously total of assets is equal to total of liabilities. So we can say total of liabilities is 17 and 21.25. And we get that we are having an asset turnover of 0.78. Industry is having 1.5. So it means in the industry, 1 rupee asset, in the industry, 1 rupee asset is causing 1.5 sale. But in our case, for 1 rupee asset, we are having 0.78 as sales. So of course, we are having a low asset turnover as compared to the industry. Then the next part says at what level of sales the earnings before tax will be equal to 0. So since we have the income statement available for us computed, now earnings after tax has to be 0. So we take this as 0, and then going by the backward calculation, 0, interest is 2,55,000, which is remain constant. So by backward calculation, we know if PBT is 0, EBIT also has to be 2,55,000. Then your fixed cost is 2,04,000, 4,59,000. From 4,59,000, you can subtract 2,04,000 to get the EBIT as 2,55,000. Then doing the backward calculation, 2,55,000 plus 2,04,000 as 4,59,000. And then just going by this simple funda that the PV ratio, we have computed the PV ratio, right? So PV ratio was 23.8%. So for 100 rupees sale, you have a contribution of 23.8. So going by the cross multiplication, 19,28,571 can be obtained simply by the cross multiplication. So this is the answer for the respective question as of now. Let me see if there are any more queries. If not, then we'll call it a day. Are there any queries? Upload the questions. Yes, I will do it. And Darshan is asking fixed cost is required. Okay, this was probably your answer to the previous question, Darshan. So I got it. Okay, so no more queries. So we're done with the chapter of leverages for the day. You can practice the questions on the study material. I have tried to capture almost all the type of relevant questions because it's basically a very simple chapter, by the way, guys. You can score very well in this chapter. And it was a nice session interacting with you, getting your queries and idea about what's your level of understanding that I was trying to portray. So it was fun teaching you guys. I hope that it's the same on the other end also. So with that good note, I wish to sign off for the day and also for this typical attempt of yours. So this was my last session with you. I hope to see you somewhere, some part of my life. Probably I don't see you in reality, but probably in some day, somewhere on the part of life, you may just interact with me. So probably you will be able to recognize me, but I may not be able to do the same. But anyways, I will definitely try to get in touch wherever we can and try to resolve your queries. So whichever platform that's possible. So with that, signing off for the day and also for the session for the entire attempt. Thanking you guys. See you soon. Take care. Bye bye, and all the best for your exams.